The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years, COVID-19 still raging throughout the planet, and the stock market, it's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live. We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, everyone. Live from Nashville, it's Thursday, November 10th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're glad you are with us tonight. So, is the low in the market for 2022? Today's activity certainly made it look like it could be, and I would not be surprised if things continue to be stronger from here. We'll get into that in just a few moments. And the election results, some of which you know. I don't know that I've got any brand new information, but I do have my analysis and how I am using that to manage your assets. These are the topics for tonight. If you're new to the program, we cover a variety of economic factors that move your portfolios. Whether you are a client of mine or whether you are just an interested person following our analysis, we are glad you're with us. If you are new to the program, please click the subscribe button on YouTube and hit the little bell so that you get notified whenever I go live. Also, I tweet every single day, sometimes more than once a day. And you can follow us on Facebook, on Twitter, or on LinkedIn. So we'll see you there on a regular basis as well. I'm going to start with the political section, but before I do that, I have to just show you what happened in the market today. And this is because of the CPI data, and I think also because of the Nevada Senate race. We'll get into that in a little bit. Dow Jones up 3.7%, SPX, S&P 500 up 5.5%, NASDAQ up 7.5%, and look at the last number there, the VIX, that's the volatility index, down almost 10% in one session. It's this kind of huge move which has now taken us back above the 3,900 level that I think could be a catalyst, especially because November is historically, at least since 1950, the strongest performing month of the calendar year, followed by December, and third is April. But these 2 months, November and December, are historically strong. And with this big move in the CPI, we think that's going to be carrying us into the new year in good form. Politics, why do we cover it? Because politics leads to policy, and policy affects our portfolio, and portfolio performance affects our personal life. So the 2022 midterms, well, didn't quite go the way some people thought it was going to go. Was there a red wave? No, not so much. Not at all. And in fact, it's just come down to the wire again. The House and the Senate have been split in favor of the Democrats. So split meaning 50-50 in the Senate, but Kamala Harris has the tie-breaking vote. So technically the Democrats do control the chamber of the Senate. And the House they control by 5 seats. It looks like right now, and there's still no call 48 hours after the election, whether the Republicans are going to keep it, but the inclination is that that's going to be the case. So what about fraud in this election? Well, I couldn't help but miss this, or couldn't help but see this missed article that you may not have caught, but a deceased Pennsylvania state representative was reelected in a landslide. His name was Tony DeLuca. He had passed away in October, so he's been dead for a month. But nonetheless, he received more than 95% of the vote. And I was watching the news conference when the Republican challenger called the guy to congratulate him. His wife picked up on the phone and said, he's not here. He can't really take your call, but thanks for congratulating us. And again, I was watching the press conference as he wrapped it up. He said, in 23 years of politics, I've never seen such stiff competition. Crazy times in America. I don't have a caption on this fella's name, but if you don't know who this is, you need to become familiar with him. He is, in my opinion, the new de facto leader of the Republican Party. He is the biggest winner of the midterm election. His name is Ron DeSantis. He's the governor of the state of Florida. We have Florida viewers on the call tonight. There he is. The last time, 4 years ago, he ran, he won by just over 0.75%. And 2 nights ago, won by 20% in a state that was supposed to be a swing state. Florida is no longer a swing state. 5 seats flipped in the U.S. House of Representatives, which at this moment looks like it could make the difference between the GOP taking control of the House. So the state of Florida had a huge impact. Who was the big loser? I'm probably going to make some enemies here, but the big loser, in my opinion, was Donald Trump. Donald Trump is no longer the front runner of the Republican Party, and he has already started jibing Ron DeSantis in the media. Big mistake in my opinion. All of these things affect consumer sentiment. Because if it looks like there's going to be a big battle and brawl for this nomination, certainly there will be nobody else that tries to compete with those two men. We'll see how this plays out, but right now, Trump is definitely the big loser because rather than being the 90th percentile as far as his endorsees winning, I think it was closer to around 60 to 65%. The tallies aren't all fully in yet. But DeSantis is the one to watch going forward. So here's where we stand. This was as of this morning, and it's actually already changed since then. 46 seats to the Democrats. Now that's really 48 because there are 2 independents, one of whom is Bernie Sanders, and those independents caucus, or they hang out with and they vote with the Democrats. So let's just say it's 48-48. Just before press time, maybe 2 hours ago, I updated this to 49%. 49 wins for the Republicans, and that is because the state of Alaska no way is going to a Democrat, even though there is not a full tally done there. And why these states can't tally votes, I don't know. Arizona is like at 68% tallied. Florida, which has almost 2.5 times the population of Arizona, was done in the 99 percentile by midnight Tuesday night. So where we stand right now is there are 3 races that will decide the Senate. I think it's a lock for the House, the Republicans to have the House. But the 3 states are Arizona, which probably is going to go to the Democrats, Nevada, which I think really is already called or should be for the Republicans, and that leaves it all down to Georgia, just like 2 years ago. So we will see how the Republicans play this out. Tucker Carlson of Fox News estimated that $200 million, folks, that's $500 million, will be spent in the state of Georgia in the next 29 days before the December 6th runoff. I'll be here on December 8th, and we will know, I would think, the Senate breakup or makeup at that time. Now, if the Republicans somehow turn around Arizona, I think they're going to win Nevada. Georgia won't matter as much. But I don't think that's going to happen. I think that it's going to go in 50-49. And of course, if the Democrats win Georgia, it's back to being 50-50 and nothing's changed. After all this drama, it would be the same. But we'll see how that plays out. The House of Representatives, 207 to 184. Just before I went to airtime, I thought another seat flipped. I thought I saw a 208. So now the Republicans are just 10 seats short. You'll see most of the country is red. I mean, except for Colorado and New Mexico, a little bit of Nevada there. That's going to be Reno and Las Vegas. The Democrat strongholds, for the most part, are the coastal regions. That's the East Coast and the West Coast. You see it in the Senate. You see it in the House as well. It's going to be very slim. It's going to be a very slim margin. There, again, was no red wave. And I hope that brings some humility to both parties, frankly. There's little room for error, and basically this country remains extremely divided. Americans' confidence in the accuracy is increasing for the Democrats, that's the blue line, and decreasing for the Republicans at 40%. And yet, I did not hear cries of, ballot stuffing or whatever going on, in this election. Now, that could creep up here as we get into December, especially because one of the 5 states that was accused of not doing a good job keeping the voting clean was Georgia 2 years ago, and Georgia once again will be formative in the deciding of the Senate, I believe, unless Arizona flips around. But they could still be counting votes in December based on how Maricopa County, which is Phoenix, is going right now. So U.S. consumer sentiment by party affiliation, I think this is interesting. Once Biden took office, both Republicans and Democrats, the consumer sentiment in America went down. So this has nothing to do with voting. This is just sentiment. Why is consumer sentiment so important? Because 67% of our economy, the GDP, the gross domestic product of the U.S. economy, is based on consumer spending. And in this case, it's consumer discretionary spending. When times are great, people don't stock up on soap and laundry detergent, which are consumer staples. But when times are great, they do buy new cars, they buy new houses, they buy clothes, they spend money on subscriptions to watch movies, okay? And when sentiment is down, that is not good for the economy. This is what we're watching. This is why politics and policy is so important, because it affects consumer sentiment. And yes, I know it affects policies that are decided here in America, but this is a financial program. So what I'm looking for is the impact on you and your portfolio based on consumer sentiment per consumer perception about our politicians. All right. So my take on all this, our government has lost all, not some, all self-control, not just the Democrats, the Republicans too, but it has been particularly bad under Joe Biden, spending trillions of dollars, much of it on foolish and needless endeavors, in my opinion. You may not agree with that, but as a portfolio manager trying to maximize the money in your accounts on a risk-adjusted basis, I want the government to protect my borders and to leave everything else alone and let the states run themselves and protect us from outside people that want to harm us. That's what the function of government is, and that's when the markets function the best, when there is not all this massive geopolitical issues and pressures, which of course we've had ever since Ukraine was invaded back in February. We've been energy dependent, this last year and a half or so, because we're dependent on our enemies. Literally, Saudi Arabia, we can claim they're an ally, but they're not really. Okay, we were energy independent only 22 months ago. And yes, that means under Donald Trump, that means drilling. I get it. You may not be on the same page, but an energy independent United States is a strong politically strong and powerful United States. Inflation at record highs. It was 1.3% when Donald Trump left office. It's at 8.7 now, although we just had a nice report this morning. We'll get to that in a little bit, which dropped. But the point is, inflation is just at harrowing 40-year highs. Many in our government seek to divide us for personal gain. Again, this is my opinion. If you don't know that little acronym there, that's in my not so humble opinion. All right? I think the government has way too much say, way too much control in our lives. And our military is way more woke than it is prepared. China, Russia, Iran, North Korea, sending missiles over the Bay of Japan there. And that's why we have all this geopolitical drama. Why do I say all this? All of these factors go into how the consumer feels about their security. Secure Americans feel like they can spend money. They can even put it on a credit card and rack up some debt to increase the quality of their lifestyle, even if it's deficit spending. When people are scared, they don't save. They just don't spend. It's not as good for the U.S. And so I want to leave you with this, though. This is kind of a surprising statistic. What is stock performance based on the makeup of Congress? All right. So if it's a Democrat president and a Republican Congress, so if the Republicans are able to get a 51-seat majority, that's the best scenario possible since 1950, with an average return of 16.3% a year. If it's split, so the Republicans will have the House, Democrats could have the Senate, then it's 13.6. Notice that either of those scenarios are better than a pure Democratic held House, administration, Senate, okay, which is on the far left, and better than most of the situations on the Republican side, okay? Pretty interesting. So that's where we are politically. When I see you next in December, we should know the makeup of the Senate. We could know earlier, and if so, certainly I'll tweet that. If Arizona were to flip, I think Nevada will, and that would put it at 51. Obviously, Georgia at that point could then make it a 52-48 Senate, which the Republicans would prefer. But the 51 number is what they're really looking at. So, all right, before I get into the monthly market review, let me look in the chat and see what we've got. All right. Hey, Greg, how are you? Good to see you. Foundation Farmhouse. Don't know who that is, but glad you're online. Hey, Debbie from South Florida. And we're back, Larry. Good to see you. Actually, Dave Ramsey is just down the road from me in Franklin, Tennessee, and he's a smart guy. So I don't know where Andre is tonight. He's usually here, but he may join us later on. New York kind of had some drama up there with supposedly the Republican governor being challenged by a Republican, and not so much when the election results came in. All right, so the monthly review, if you didn't see this earlier, I just wanted you to be sure and note we really had a fantastic day today in the market. We've needed this. The market was pretty deeply oversold, and I think there's been money on the sidelines. We're about 80% invested, so if you're in CG, you'll notice there's 20% in short-term treasury notes, and that's just basically to provide some stability with these big spiky down moves that we've had most of the year. The high of the year remains January 4th. All right. And I really thought that in the fourth quarter, which is like 6 weeks more, we were going to go back to lifetime highs. I don't see it. Could that happen in January, February, first quarter? Absolutely. Does some of that have to do with whether the Republicans, control the Senate? Yes, it does. Whether you like that or not, you saw the stat that I just showed you. Split government with a Democratic president and Republican House and Senate, 16.3% annualized return for the next 2 years until the general election. So I'll take 16 anytime. All right. This chart you guys have seen many times. It's 100 years looking back. The three blocks in red are the secular bear markets. The long blue lines are the secular bull markets. Within a secular bull market, you can have cyclical bear markets. So lean in and see that yellow on the screen. That's where we are right now. We are in a cyclical, bear market. Okay, we had this in 1987 during the last secular bull market when the market crashed. All right, and we've had a big pullback this year. It feels like we've never had a worse bear market than this, right? No, that's not true. Okay, since 1950. 53.5 roughly percent of the days have been up, 60% of the months, 75 of the years have been up since 1950. Now, since 1971, going back a little more recently, 56% of the days have been up, 66 of the months, and 75% of the years, roughly 74.5, have been up. That bodes well mathematically. Sorry, guys, I'm a little hoarse tonight. Maybe a little too much yelling at the TV. So we are in a good place right now on the calendar. I've already told you November, December, then we got the Christmas effect, January effect. If we can get some stability on the political front, if we can, Putin, I don't know whether he's going to continue to threaten, nuclear tactical weapons. I don't know. But when these sort of things calm down, the market can get back to doing what it's doing, which is evaluating earnings and interest rates. And if the Fed sees what I saw today, it ought to be going, we don't need to do 75 basis points anymore. Inflation's coming down. Our work has been done. Okay. So the biggest stock market crashes in history, 1929, and I've been alive I've only been alive for 4 of them, and I've been a money manager for 3 of them. All right. 87, 1999, 2000, 2008, 2020. Where's 2022? It's not on there. Why does this feel so bad? And I say this on every show that I've done this year, at least starting in March. It's the length. It's not the depth of this bear market that is so painful. It's the length. It just nags and nags and nags. And since I've seen you, I caught COVID. Okay? It was not fun, but it was really only bad for about 2 days. And I was never threatened with my life. I've got vaccinations and, it was just uncomfortable. But it continues to nag. And if you hear it in my voice, that's part of what's going on here. It just nags. And that's what 2022 has been, just nagging at us. All right? So don't be discouraged. We are not near any of the 5 biggest market crashes in history. All right? And if you think that those are crashes, you may have seen that crypto plummeted on Tuesday, and here's why. Sam Bankman-Fried, or Fried, whatever his last name is, net worth was, when he went to bed on Monday night, $15.6 billion. Well, his company crashed overnight, and now his net worth is under $1 billion. It's hard to feel too bad for anybody that has $1 billion almost, but 93.6, that's a haircut. That's a really bad haircut, and that spooked the markets as well, okay? So these geopolitical / crypto / whatever influences on the market eventually will stop, and the market will go back to working on what it does best, which is rewarding companies that have strong earnings and that tell the truth when they're projecting earnings. Okay. So you guys know this chart. I show this at the end of every section when I'm talking about this, and we are nearly at the end of earnings. They seem to go by quicker in the 4th quarter. All right, which is, of course, reporting on the 3rd quarter earnings. But 428 companies have reported, and we're at 71% that are exceeding what they projected for their earnings. All right. And the winning sectors are industrials at 78, technology at 79. We got consumer staples up there at 77. So it's not a lot to write home about because 73 is the norm. It's a little under that. But earlier this year, we had numbers in the low 80s. So all this is to say, earnings are holding their own despite all of the junk that I've been telling you about. When earnings can do that in the face of geopolitical, inflation, and just crazy stuff happening overseas with both China and Russia, stocks holding their own because their earnings projections are not being misled, except for communication companies like Meta and Amazon, and Microsoft is really looking weak right now. But for the most part, it's been a solid quarter for earnings. All right. Inflation. Let me look here at the chart. What am I missing? Your friends, yuck. Where's Andre? Okay, I'm late, but I'm here. Okay, Nellie. Good to see you. Nellie hails from Atlanta, which is becoming the most important city in America for the next 30 days. How about that? So, this is the report that came out today that stunned the market. So we have a speculative program. I had a day trade in the S&P 500 today that lasted 9 seconds. We got back on the right side of the market and had a really good day. But when you have a shock to the market, like they were expecting 8.1, a drop from, you can look on the chart and see this is CPI, which means the annualized inflation report, 8.3%, 8.2, is supposed to drop to 8.1 or 8.0, and it dropped to 7.7. May not seem radically, improvement, but in the size numbers we're talking about, it is. And again, nobody was expecting it. So that's why the market had the fantastic day that it did, the data that I showed you earlier. This bodes well. If we were to see something with a 6 handle, 6.9 even. Now the next inflation report, this is cool. December 13th, right? December 14th is the Fed announcement. So if the next CPI comes in at a 6 handle, 6.9 even, not 6.8, 6.6, be great. You're going to see the Fed maybe even do a 25 basis point cut. Not a cut, pardon me. An increase, but not a 75 and not even a 50. So we'll see. And of course, the market will just love that. Markets love low interest rates. Consumers love low interest rates. Mortgage companies love low interest rates. Builders love low interest rates. Who loves high interest rates? The banks, because they get to charge you more interest. But for the most part, the majority of society benefits from lower interest rates, okay? This is frustrating to me because our president stands up there when he's holding an ice cream cone. I'm sure you saw this and says, wow, we've got the lowest inflation in the world. We're lower than Europe. It's like, Mr. President, would you please look at the stats? This is from FactSet. Okay, this is from the Daily Shot. This is 3 different sources. They're in the footer down there. There's Eurozone inflation in the blue. U.S. inflation in the red. This is a trailing 2-year period. Okay? This is the data. So yes, inflation is worse here than it is overseas, Mr. President. Now, what's the real challenge here? As items become more expensive, so look at the blue line going up with a little arrow there. People are spending more money on staples. No, it doesn't mean Scotch tape and staples. It means staples like detergent and food, okay, and shoes, all right? And where we want to see consumers able to spend money is in discretionary items, things that we want. Staples are things that we need. I'm checking my list here, see if there's anything I'm missing. All right. When we see this turn back to the other way, that's when we know we have a strong economy, because people are confident enough that they're spending more on discretionary items. All right. Right now, that is not the case. It has not been the case all year. This is starting from December, so it's a 1-year chart. All right. So this needs to turn around. All right. Now, deflation is coming to car prices. One of my clients actually sold me my most recent car and said, yeah, it's a whole different story on the lot right now. We have more cars on the lot. Nobody's bickering or paying a premium for a car. And we're even seeing significant drops, and it's right here on the chart, for used cars and trucks. Why is this good? Because it means that demand is cooling. If demand is cooling, what happens? Okay, the price is coming down, all right? Because there is too much supply and dealers don't want to sit there with supply on the lots. It's the same way with houses. It's the same way when you go to Kohl's, all right? When demand cools, just instinctively, you can see why that would cool inflation. And that's what we want to see. We want the Fed to back off and just let the economy work the way it does. I understand that they don't want to turn this into Uganda with 38% annualized inflation. It would just destroy the country. So they're doing their job. But it's okay to see data like this where there is some deflation coming in. And the major 2 categories for discretionary spending are housing and automobiles. Okay? All right. Hey, Debbie, how are you? In South Dakota, where you reelected your government, or governor last night. I'm having a tough night, guys. I've been talking too much. And I'm a little tired. But anyway, good to see you. I think we've got about 6-7 states represented here. This is great. All right, so the employment scenario now, this is kind of old data because it's from last Friday. So the expectation was 193,000 new jobs. It actually came in at 261. So you can see that's the red bar on the chart. You might say, well, that's going down. That's not so good. And the media, of course, is quick to point this out because the media at the top of the list would be Bloomberg. Job creation's trending lower. But this pace of labor market growth continues to exceed pre-COVID levels. This is the chart they should be showing you. Okay, so the purple line is the trajectory we were on, and then boom, in February of 2020, plummeted. Okay, just plummeted, and then rocketed back up. What is this? Everybody knows Dr. J's favorite line, the V-shaped correction. Okay, we are back above pre-COVID levels in our total levels of payrolls. And that's what we want to see. The unemployment rate did edge up, but from 3.6 to 3.7, really not a big deal. You can see historically, it's still way at the low end of the spectrum. U.S. is still hiring on all cylinders, guys. It really is. Now, I know you saw in the news, and I actually have a near and dear person to me in my life who works for Meta and was not part of those layoffs. But when you have a company that lays off 13% of its workforce, 11,000 people, you tend to pay attention to something like that. But those are the anomalies. That's not widespread across multiple industries. It's these big communication companies that are just getting to where they're having to right size based on demand for product right now. So, and of course, they're doing some R&D as well. But the U.S. basically is still hiring on all cylinders, and that's a great thing. Economic indicators that I'm looking to as we finish out the year here, what is going to drive the market? Construction continuing to hold up. Now, I think this is pretty amazing. When I got my mortgage here in Tennessee, we paid 2 5/8. I know a couple of you that somebody's told me they got a 2 1/2 or 2 3/8. I don't know anybody that could have gotten a 3/8, but I hear it. I have one client that got a 2 1/2, but we got a 2 5/8 when you're at 7.2 right now. That we are still seeing demand for construction is amazing. What does that mean? It means the consumer is resilient, that they do not believe this is a long-term problem. They do see inflation coming down and they think we're going to be okay. Again, consumer sentiment is important because the consumer drives the economy. And when the consumer is spending money, that's great for stocks. All right. We are seeing jobs dwindling off current year. Okay. So the hiring has, crossed over from in the month of May here from previous year to this year. I mean, that's when the hiring freezes started to set in. Layoffs started to set in. It's just not widespread. It's not like during those first couple months of COVID when all these businesses just shut down. And yes, I see that, Nelly. Yeah, the companies had probably oversized, now right-sizing. Yes, and we've been right-sizing for centuries. It's not even just in the industrial revolutionary age, okay? So every business has to have the right number of employees for the right time to be profitable because it's got to work for the employees, it's got to work for the shareholders, it's got to work for the people that own stock in the company, all right? Small business optimism, this is the same sort of challenge that we saw earlier in consumer sentiment. Small business, half the business in America is small business. They're not at a full low that was earlier this year, which was when CPI was the highest. The high point of the Consumer Price Index, if you remember about 8 screens back, was June of this year. All right, it's been steadily coming down since then. It was just that it was a dramatic downturn 2 days ago. Or pardon me, this morning when that news came out. All right. So this optimism index will turn back up if the market continues to push through this level and get back to about the 95 level on this chart. We'll know that when I show it to you in December. Still tons of openings in healthcare and social assistance. That's because those of us that are baby boomers, and you may know that some of us on the line here are class of 73. We are in the dead center of the baby boomers, 1955, and we are going to need health care. And that demand is going to be there for quite some time. So Healthcare, really strong section of the economy in the U.S. right now. Fed's been out of the news a little bit because the political news, of course, has been so strong. But basically, the Fed would like to see, in my opinion, these openings to unemployment ratio. So that's kind of a wordy way of saying, where are the openings? What's the unemployment ratio? When this gets stronger, then they feel like they can back off a little bit. But they're not seeing that yet, okay? It does not look like a signal to pivot. Pivot in Fed speak means, okay, we'll stop raising interest rates. Now we're going to start reducing them, or at least shrinking the size of the increases, which I think is what's going to happen in December, just based on the CPI number that came out today. So, all right. Fed funds target rate, we're at 4%, which I know because it went straight up. You can see the straight line there, where it was a little more gradual back in 2003, or even like between 2016 and 2018. It's what they call stair stepping. There's no stair stepping. It's just straight up this year. And it all happened in 1 year, as opposed to the last time the Fed increased rates. And that's why it's been painful. And that's why it freaks people out. All right. But if we see this again, we can see them back down to a 3 handle. I think that could be absolutely in the cards next year at this time, certainly by the end of next year or into 2024. I think the Fed's inflation target at 2% is where we're headed. Okay. So I just wanted you to see, I haven't shown you this chart ever, but this is what happens on days when the Fed makes an announcement about policy. Look at the huge moves. We've got a 3.5%, 4% move to the upside, to the downside, and that's just 1 month apart. These are the various months going back 28 years to 1994. And most recently, the worst one day we had was the last Fed day. Okay. And of course, before that, it was Jackson Hole in the month of October, which caused, the Fed has the ability to just rankle a lot of people's nerves. And what I'm hopeful is, as this inflation data ebbs, meaning the high inflation data ebbs, that the Fed will be able to take a little quieter approach, stay out of the headlines, and just let the market function. You can see here in 2015 and 16, those smaller bars, and that's because the Fed was not making any dramatic changes. The market appreciates that, all right? What has been the outcome or the financial shock crisis that's motivated the Fed? Look at the various years on the left-hand side, and then what happened, the Continental Illinois, which was a huge bankruptcy, Black Monday, 1987, the tequila crisis. That's really interesting. I had never heard of that in 1994. That sounds like it would disappoint a lot of my classmates that enjoy tequila, but I digress. Russia long-term capital management, Eurozone crisis, the pandemic, of course, in 2020, and then global inflation shock is what we're calling this year. All right. That's the only time going all the way back to 1984 where the Fed has tightened. You can see ease, 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 pause, which means nothing happens. More quantitative easing, which is another variation of easing. When the Fed starts tightening, everybody takes notice. Okay. And that's why this current period has caused consternation. Again, when you add that to the political drama, the geopolitical drama, and what's going on with Russia and China, it just doesn't make for a great environment for stocks. And yet, they're still not down as much as they were in the COVID crash 2 years ago, 2.5 years ago. All right. The Federal Reserve is showing no sign of taking its foot off the accelerator. And I wrote that 2 days ago. We'll see if they think this is an aberration today. Then they won't. If they don't think it's an aberration and they think, okay, we got to really look at some data because the market spoke today and said, we're believing this reduction in inflation. Its aggressive monetary policy will more likely be more important to the markets than who ends up in control of Congress. I'm not so sure of that. I did write that a couple days ago and I left it in here. We'll see. It's going to be real interesting. I think by December, we're going to have a lot of answers that we don't have right now. The housing market, this surge in mortgage rates has just quelled a lot of buying. You see the line just collapsing there. That's headwinds for the market. Basically, when this is an inverted 30-year mortgage rate, so when the 30-year mortgage is going up, the number of buyers is going down, and it's a plummet. There's just no way to get around that. Okay, year over year, house appreciation also dropped. We were seeing at one point on a trailing year, 15.8% increase. I mean, I don't know if you've looked at your house on Zillow or whatever you use, but we had at one point a 55% increase. And we've been here not even 2 years. Now that has pulled back just like it has on this chart. I'm okay with that. If you have a house that's making 10.3% a year, you ought to be glad about that. And in fact, if it's making 15.8, you ought to be concerned about that. All right. I've said this before on shows. Don't let this discourage you. Okay. Year over year price change. Look at the yellow of 10 to 15% by the end of 2023. That's outstanding. And of course, that varies state to state. Okay. But be aware of where it is and where you live. And if you live in a state where houses aren't appreciating and you got bad government, come on down. Because things are run pretty well here in Tennessee. I have to say this, I'm sorry, but here they've got all this drama about who's going to win the election. The polls in Tennessee closed at 7 p.m. At 7 p.m. and 8 seconds, Fox News projected our governor and 4 of the House seats. There was no opposition in 2 of our 9 districts, and in 1, the Republican won by 81%. So, would all states be that easy? It would be helpful rather than, again, this ongoing drama that just goes on and on and on. But I digress. Okay, listings obviously falling off as well, but again, a little less demand, not going to hurt us anything. If this continues and listings continue to fall off, what does it do? Then the inflation kicks in again, right? Again, not such a bad thing. 30-year fixed mortgage rate. This is pretty astounding. I want you to look at the dates on the left-hand side. So on October 26th, 7%. All right, 707, and then 704, and then 708, 713, 79, 720. This is a week, folks. I mean, this is moving like, a high-tech stock, interest rates. Again, we'll see what the effect is from today's huge move in the CPI number. Now, obviously, the Fed is going to control the short-term interest rates. The long-term interest rates are controlled by the market, thank goodness. So anyway, a little shorter than normal, but that's it. That's what's going on right now. Those are the areas we covered. I'm going to take a break for a second and get a sip of water and see if I'm missing anything. Good to see you, Keith. Finally able to get your YouTube chat. Hey, that's great. I didn't know any Democrats live in Tennessee. As I said, we have 11 electoral votes in Tennessee, so that means you should know this. How many representatives do we have? 9, right? Because you have 2 senators and 9 representatives. That's 11. That's the number of electoral votes you have. A state like New Hampshire has 2 senators and 2 representatives, so they have 4 electoral votes. 2 of the 9 races were unopposed. Unopposed. And the one that the poor Democrat, I felt sorry, got like 11%, But then you have districts where like AOC won 71% of her district. Nancy Pelosi, 81%. Ironically, that's her age. 81%. We are a very polarized America. It will not change in my lifetime. So, yes, easy GOP win there, just like an easy Democrat win for Pritzker in Illinois. So, all right, guys, anything else? Congrats again to Christy Noam in South Dakota. Things pretty good. I sense that, especially with this move today and the shock to the market, that there is pent-up money coming in. If this move continues, I would expect to be 90% fully invested in CG and GI next week. I probably won't go 100% until I see the 4,000 level taken out in the S&P 500 because we're still down. I mean, it's great to see this kind of big day, but we're still down on the year for sure. So anyway, the next show, Thursday, December 8th. Tell your friends, tell your family. We'd love to have more people here. Any questions? Anything at all that I've missed here? Okay, I don't see it, guys. But if you live in Georgia, go out and vote again. Okay, it will be the most watched race in America this year. There's just no two ways about it. So I always end the show with this, and it's just a good way to do it, guys. Okay, from 2 Timothy. For we have not been given a spirit of fear, but a spirit of power, love, and of sound mind. We are very blessed to be in this, the greatest country in the history of civilization. We are not a perfect country, but we are indeed a noble country. And when you sit in front of your Thanksgiving table this year, I hope that you'll say thanks. And if you're a believing person, thanks to God for getting us this far, because the way that we treat each other, and, it concerns me. A sense of civility has been lost in this country, and it troubles me. But each of us on our own can do our part to keep civility, to bring it back into vogue, if it were, so to speak, and just be grateful for the many, many blessings we have. Hang with us, and we'll see what happens in December, but I think that we're going to finish the year on a strong note. If you have questions, comments, whatever, cb3@cb3.com. As I always want to say, at CB3 Financial, we don't just manage your assets, we become one of them. It's my privilege to speak to you every month like this and wish you the very best as we head into the very last weeks of the year. Good night, folks.